Hello, everyone, and welcome to another Wall Street for Main Street podcast. Today we have a returning guest, Adrian Day from Adrian Day Asset Management. He's been featured in many programs, Kitco, The Gold Report, and we're happy he can come back on. Thank you, Adrian. Thank you for coming back on.
Well, thank you. I appreciate it.
All right. First I want to get into is an interview I listened to from you, I would say, a couple of months ago. About Austrian Economics, and you actually met Friedrich von Hayek. I was wondering if you could go into what got you into Austrian Economics.
Well, interesting, and good evening, and thanks for having me. I guess like a lot of people, people come to Austrian Economics from different directions. I grew up in a pretty traditional middle-class conservative with a small c, but also with a big C in England, conservative household. And I guess I was attracted to the wing of the Conservative Party, just as over here the Republicans, there's the Tea Party, there's the Rhinos, although not many of those exist anymore, but, there's different wings to the party, and I got attracted to the wing of the party with people like, these names won't mean anything, but Nicholas Ridley and Enoch Powell. Some of you people may know Enoch Powell, who was, on what's called the right wing of the Conservative Party, but most definitely, free market oriented. So I began to get attracted to that, and I think it's from the political angle that I came to be attracted to Austrian economics. I was extremely fortunate when I was at the London School of Economics. I was chairman of a Conservative Party. I think there were about 5 members, but that's a joke. But not many more. Even if you were conservative, you didn't really want to publicly proclaim it. But I was very fortunate to be invited by the Institute of Economic Affairs, that you may know, which was a British think tank. I was invited to several of their meetings, and one of the things they used to do was have these little lunches with maybe 5 or 6 people, including maybe an academic, a politician, a newspaper journalist, a student, and, just mix it up a bit. And I was extremely fortunate to meet von Hayek in one of those meetings. He also used to teach at London School of Economics in the 30s. And so he came back to London School of Economics while I was there to do a series of guest lectures. So, I was fortunate to hear him lecture as well as to meet him.
Oh, okay. That's pretty neat. So I haven't heard really any. I guess I've heard Tom Woods lecture once. So that was at CPAC a while back. So I guess I had a similar sort of background, sort of where I was sort of conservative, but the only reason I was is my dad as a kid always complained about taxes, so it was like ingrained in my head that they're evil. So it's sort of and I found out about through the internet. So and also speaking of Austrian economics, one of the biggest critics they have is of the Fed. Currently, they seem to be in the middle of tapering, and they're supposed to end in October. Do you think there's any chance it can either reverse course, or do you think they might end and come back with a new policy in the future, or they might end it and then wait for a crisis? They always seem to restart one on the crisis. What do you think might have in store? I know it's sort of a bounce around question, but
yeah, and of course, I think the Fed tends to be reactive rather than proactive. And so, as you said, with QE1, QE2, QE3, they stopped the programs, but then as soon as something happened or didn't happen, the economy didn't improve, or something went wrong, the stock market fell, they introduced, the next round of QE. And so I think there's a fairly high chance that we'll end this additional bond buying that they started. Now let's not forget that all we're cutting back on is the additional bond buying that was introduced a year ago. the Fed policy, even if they continue to taper that away to nothing, the Fed policy will still be extremely accommodative. And I think that's the main point I would make, or the two main points I would make. Number one, Fed policy remains accommodative, and the odds or the chance of any meaningful tightening in the reasonably near term, I think is pretty close to zero. What you've got to watch is not so much whether interest rates eventually go up, but is the Fed raising interest rates ahead of inflation, or are they simply lagging behind inflation? Because if all the Fed does is raise interest rates after inflation has moved up, that's not tightening at all. And then the second thing, if I may, we have to remember is the monetary policy remains very, very easy around the world. So even if the Fed does manage to restrain itself a little bit, nobody is yet talking about any serious tightening, any shrinking of the Fed balance sheet and raising interest rates meaningfully ahead of inflation. No one's talking about that yet. But even if the Fed does sort of, Fed policy stabilizes, the rest of the world, Europe, Japan, Britain, is still very, very, very easy policy. So, yeah, monetary policy around the world remains easy, no question.
Oh, yeah, you see Britain, Japan, even China talks about new QE programs. That definitely, and not only that, these currency swaps are now permanent. You look at that, they can easily, like when the Fed started tapering, all these new treasuries arrived in Belgium, which was very unusual from what I'd see. And I was also wondering, in terms of QE1, they just ended it. QE2, they just ended that. But this time, they're actually, do you find it a little unusual that they're now slowly tapering this one instead of just ending it like they did QE1 and 2?
Well, I'll be honest, I'm a little bit surprised that they've continued to cut back on the bond buying each month in the way they have. I thought we would get a stumble or a reduction in the cutback at some point. So I'm a little, I must admit, I'm a little surprised at that. But I'm not really surprised that they're cutting back. Let's face it, this was an additional $85 billion a month, and they announced $85 billion a month. But as you know, some months they actually bought more, over 100 in 1 month. And so by cutting back the way they're doing, remember, we're only cutting back what was added. It's a bit like, the budget. When Congress announces a 4% reduction in the federal budget, it's a 4% reduction on a 10% increase. So I feel it's a bit like that with the Fed. Monetary policy is still far, far too easy in my view.
Yeah, it's definitely easy. Not only that, the Fed's balance sheet's at an all-time high. I believe it's over $4 trillion. I'm not sure the exact number.
Well, neither am I, to be honest, but it's getting very close to 5. Very close to 5 trillion.
Yeah. So obviously they can't be tapering too much, and
no,
as you said, it's tapering an increase, not a not an actual taper. So
right.
One thing though is ever since they've tapered, the housing numbers have gotten worse and worse from my viewpoint. I would say the data's mixed at best. Do you think we're anywhere near a housing crisis in the near future, or is this just a slowdown, or is this something else, I guess?
Well, all these things are dynamic, of course. What happens in the housing market is partly dependent upon what the Fed does, and particularly interest rates. But equally, the Fed's interest rate policy will be partly dependent upon what happens in the housing market. So all these things are interdependent. I don't think we're near a crash. Did you say crash or crisis? I don't think we're near another crisis or crash in the housing market. I don't say we're not near it. We're not close to it. That doesn't mean it won't happen, a year from now. But I don't think we're close to it. But I think what you're going to see, you're absolutely right. But not just housing, but economic statistics generally in the last, 3-4 months and I would say economic statistics this year, but increasingly the last 2 to 3 months, have been mixed at best. You've seen it in the housing prices, housing starts. You've seen it in the new claims for unemployment. You've seen it in consumer confidence. You've seen it in many, many reports across the board. Now, I am not saying that economic reports are universally negative. Of course they're not. That would be silly. The economy is, albeit slowly, still growing, and growing again at a far, far lower rate than it should be this long after a recession. But nonetheless, it is growing. But there's no question that over the last several months, reports have been very, very mixed. And a preponderance, the shift is turning towards more negative than positive, And I suspect one reason for that is it's in response to both the tapering and also fears of higher interest rates. And so the question remains, which you started the interview with, the question remains that if the Fed keeps on this course and then the economy slows down or the stock market, declines, will the Fed simply reverse course and start pumping more money in? And, I suspect the answer to that is yes. But, there's two things on the economy, I think. One is, what you've suggested, what we just talked about, that, economic reports are mixed and economic growth is pretty lackluster. But I think the other thing that's really important to realize is that on a long-term basis, there are really some structural problems in the U.S. economy. I mean, you look at private sector full-time employment, right? And private sector full-time employment is no more today than it was 10 years ago. That's astonishing. You look at unemployment today and you compare that with 10 years ago, and then you look at the number of people, you look at the labor participation rate, which is the number of people aged, depending on what statistic you use, but aged 18 to 65, the number of people in that age group are actually in the labor pool. Now, a lot of reasons why people are not in the pool. There was a wonderful article in Barron's by Gene Epstein, I think 2 weeks ago on this, and he looked at males from 25 to 55, and he looked at that group because he said, if you look at that group on a long-term basis, you take away a lot of other changes that are happening, like more women entering the labor market, women leaving at a certain age to have children, people retiring earlier than they used to, people who are younger staying at college longer. So you take away all of those sort of other things and just look at the people from males from 25 to 55 who you would expect to be working, right? In a, let's say, normal, in quotes, in a normal society and economy, you would expect those people to be employed. And labor participation has gone from 97%, which means 3% are not in the labor pool, down to 88% over the last, 12, 15 years. So that's 12% of males from 25 to 55 are not even in the pool. And, so there's some structural things that the month-to-month unemployment rate doesn't capture. And I think that's very negative. The other thing that's very negative to me, frankly, is you look at this recovery, and there was some, certainly CNBC heralded it when a few months ago the total net household wealth in the U.S. Recovered above the 2007 peak, right? Now, let's face it, over a period of 7 years, you would expect the net household wealth to go up. That's what you would expect. Similarly, the net household income went up and exceeded the 2007 peak. Again, what you expect. But when you dig into those numbers, you find something really astonishing. And I'm not a socialist, but you find that the vast majority of the increase in wealth has come from the top 10, 5, and even 1% of the population. So if you look at wealth, for example, you look at the lower, let's call it lower, the bottom 50%, okay? So the bottom 50% by household wealth in America is actually declined, has actually seen their wealth decline from 2007 to the current. And the bottom 50, I'm sorry, not the bottom 50, what am I talking about? The bottom 90%. The bottom 90% has seen their wealth actually decline. And for the bottom 50%, that household wealth has actually gone down by 44%. That's astonishing. So it's as a group, it's only the top 10% who have seen their wealth increase. And of course, for those people, if their wealth increases by 3, 4, 5%, that means that overall wealth goes up a lot because their wealth is higher. So again, I'm not complaining about the 1% and the 10% making a lot of money, but I do think that there is something fundamentally wrong when the bottom 90% see their wealth actually decline over a 7-year period.
Yeah, that's a great point. And the other thing is, you said you're not a socialist. The funny thing is about capitalism, the biggest benefactors, Henry Ford, obviously, in his business, he was the biggest benefactor. He made Ford and made fortunes. But the reality is most entrepreneurs fail. Generally, the biggest benefactors are the employees, are the people that Henry Ford gave people 5-day work weeks, so they had weekends off. They paid them the highest wages. And it was actually the employees who actually benefited the most from capitalism. And I think that's actually a branding problem with capitalism, is that you can show we don't have capitalism here because it generally lifts people out of poverty.
No, absolutely right. And what's been happening increasingly, I mean, I'm sure you agree, what's been happening increasingly in this country is you have crony capitalism that isn't capitalism at all. And so you have, I mean, why did we have these huge bailouts in 2008 and 2009, these huge programs by both Bush and that second one by Obama? It certainly wasn't, despite the rhetoric, to help, poor people in middle America, pay their mortgages. It was to bail out the banks. And so you've got this symbiotic relationship between the big banks and the government, each sort of supporting the other. And when I say each supporting the other, look at the fines that the big banks have paid this year. The big banks in America, only American banks, the big banks in America have now paid almost $50 billion in fines to the federal government, right? $50 billion. That is a meaningful contribution towards the federal government budget. That's meaningful. Now, how much of that has actually gone to these remediation programs? Like if Bank of America was fined for their deceptive mortgage practices, how much of that money has actually gone to remediation programs for the people who bought the toxic loans? And that's a whole other argument as to whether they're faultless. But it's something like $1 or $2 billion has gone into paying back the people who was allegedly hurt, and the rest of it has gone to the federal government. So it's a totally symbiotic relationship. The federal government puts $800 billion in TARP, which is to bail out the banks, and then when the banks are back on track, then the banks pay, $50 billion. And as I say, that's just the U.S. banks. You add on the fines this year that are being paid by foreign banks to the U.S. government. You add on the other fines for other kind of non-bank financial companies, and you're up to about $80 billion. Again, a meaningful contribution towards the U.S. Federal budget. And nobody seems to be noticing this or talking about this.
Yeah, fines is another word for taxation. It looks like.
Well, I think so. And again, I'm not a defender of big banks, but I don't think these fines are because they did something wrong and it's to help the people that they wronged. It's not that at all.
Yeah, I definitely agree with that. And speaking of banks and everything, lately the stock market's had quite a tear. Not lately, like a couple of months, but I mean longer, since I would say '09. And right now, I read an article, and it said you cannot lose in equities. And I was wondering, one is, I personally, when I saw that, I thought that looked like we might be near a top. Might not be the exact top. It might be even a year from now. But do you look at that as a contrarian play on the stock market, or that we might be near a top?
Oh, absolutely. Because I didn't hear a lot of people in 2009 and 10 saying, oh, you can't lose in equities. You heard it in 2006 and 2007. And I haven't heard much about talk so far, but if you're hearing that talk again, that's definitely a sign of the top, yeah.
Yeah, I saw it in a Yahoo Finance article, and when I see it, they talk about how you can't lose, and I'm thinking, did they forget the tech bubble or the housing bubble? Is that, it wasn't like those two events were that long ago.
Well, no, and you look at the entire decade, let's see, from 99 to 2009, the S&P actually was down over that 10-year period. I mean, you look at other periods you've mentioned where you can lose a lot of money in a very short period of time, or go back to the 66 peak, and it was 1982 before the stock market, the broad market, exceeded the 66 peak. It's late at night, so that's not too quick, but that's a long time, to use a technical term. So, so when people say you can't lose, you've got to define exactly what that means. Do you mean over 50 years you can't lose? That's probably true.
Yeah, I definitely agree with that. The stock market has done well over long periods of time, but I believe also from like 29, if you bought equities in 1929, it took till 55 to actually break even.
That's right. That's absolutely right. Yeah, if you just held on to them. And of course, in today's market, we don't even have decent dividends to sort of, offset some of the decline. I mean, the stock market today, I feel, is not grossly overvalued. It's certainly not at those sort of manic levels that you mentioned of the tech bubble in 1999, 2000. But it's certainly above its long-term historical averages. And so I think it's flashing at least some kind of caution is the way I look at it. But, I don't look, I manage money, right? So when I'm managing money, I'm not trying to make predictions about what I see in the future. I'm really looking at risk and reward. And if you look at risk and you're conscious of risk, you can often miss out on upside, right? That doesn't mean you were wrong. You just got to balance what's the potential, what's the risk, what are the odds of one or the other. So, it wouldn't surprise me if the Fed, comes back with some more QE of some type or another, then, it wouldn't surprise me if the market continued upwards. But nobody could call the stock market cheap at this point. Nobody could say that it's without risk at the moment. We're trading at over 18 times earnings, trailing earnings, which is, well above the historic average, more like 15.5, 16. But certainly on dividend and book value, we are trading well above historic valuations.
Mm-hmm. And yeah, as a value guy, I don't see much value. I would say the most value would be in the resource sector right now if you were looking to invest. Would you agree with that? Or?
Well, I think so. Yes. I have to admit that I'm just in the very near term, I'm just a little bit cautious on the resource sector right now, primarily because of the dollar. anytime you look at any market, there's, positives, negatives. That's what you do. You look at the positive factors, you look at the negative factors, you're trying to kind of weigh them, you give weight to each of them, and you try to make some kind of assessment of risk and reward. And if you look at, the resource market today, I think the global monetary policy is definitely a positive for gold and a positive for other commodities, resources. The geopolitical situation is a positive for gold, positive for oil, less positive for other resources. But certainly dollar strength is a significant negative for the resource market. And it's difficult to know how long that's going to carry on, to be honest. I mean, I think it's important to say that up until, people have all year been talking about the dollar strength, and I was wondering what exactly they were looking at. But I'm talking about from the middle of July onwards, where the euro started to go down and the dollar on the index went from, 79 up to about 84. Doesn't sound like a lot, but that is a huge move in the currency market. So I think that's got to play itself out before gold really turns around strongly. But, I mean, if you look ahead 6 months, I'm very bullish on gold.
Yeah, and I was wondering, you look at the mining stocks a lot and the mining companies. Right now, from what I'm seeing, is a lot of them are really taking big measures to cut their cost, to increase their cash flow, divest their assets. How much longer do you think they can survive these prices of low prices before they shut down? Now, I personally think it could go on a lot longer than people think, just because it's so expensive to shut down a mine and then have the restart.
Well, that's a good point. And not only is it very expensive, it's expensive to shut down and very expensive to restart, but with some mines, once you shut them, you don't restart. Like, the deep mines in South Africa, if you were to close those, they probably would never restart, or never's a long time, but for a significant period of time, because, without expensive care and maintenance, very expensive care and maintenance, the shafts flood and so on, and then it becomes very expensive to restart them, so you need a significantly higher price. But I agree with you. Well, two things, if I may. One is, I think you're right that it could carry on a lot longer, because let's not forget that in the resource sector generally, when a company's considering whether to close a mine, they're looking at their marginal cost of a marginal ounce, right? So all the money that's already been put into the mine, the capex, becomes irrelevant at that point. You've still got to pay it back, of course, but in terms of the company doesn't look and say, oh, gee, we're losing money on this mine if we include all our G&A, general administrative expense, and all of our capex and our amortization and our remediation and everything else. They don't say that. They say, well, you know what? The cash cost here is only $700 and gold's at $800. Let's just keep on. In fact, let's mine more of the stuff to try to make up some profit. So it's a short-sighted way of looking at it, but it does mean that declines in price tend to the company tends to react to price changes, up or down for that matter, much slower than, say, in other industries. Like a shoe store or something. You have a shoe store and people buy more shoes one week, and they buy more shoes the second week and the third week and the fourth week. Well, what do? You order more shoes from your wholesaler. But the mining companies tend to react much more slowly than that. The other thing I would say is one of the reasons we're seeing all these cost cuts and mines being sold and everything else is not so much because of a decline in the price, but it's because of the, if I may, the absolutely ridiculous and stupid decisions that were made by many of the mining companies back in 2006-07, and then again in 9 and 10. Mining executives are not much different from most of us. They sort of extrapolate way out into the future. They think a trend is going to just continue. And so if you look at when gold was at 1800 and even 1900, you look at all the acquisitions that were done in those years, expensive acquisitions of very, very marginal mines. But they were buying these mines because they were afraid that, if gold went to 2,500 or 5,000, there wouldn't be anything available to buy. Now, when gold's come down, you hardly see any companies out there buying. And this is precisely the time they should be buying, frankly.
Yeah, I definitely, in terms of value, I think you can buy a lot of these miners for the cash in the bank for what their cash value right now, plus all their resources. It's unbelievable how the market just keeps ignoring it. And I know you manage a lot of mining funds. You manage Peter Schiff's Euro Pacific one, and you have a newsletter and everything. I know you talked about mining stocks in the past. Do you look at any that you like right now at all, or?
Yeah, I think, and I hate to sort of, qualify all this. I think the first thing someone has to do is decide if they're, what kind of investor you are. Are you a trader or are you a long-term? Are you looking for leverage to gold, or are you looking for a great company that will do well if gold goes up? Because here's the irony in the mining business. The irony is that in a strong bull market, the stocks that will tend to perform best are the more marginal companies. If a company has high costs and a lot of debt, right, which is not a good company, they will in fact have more leverage on a higher gold price than a company with no debt and low costs, right? I mean, is that obvious? And so you have to decide what kind of investor you are. Now, a couple of stocks that I really like, Franco-Nevada, which is a royalty company. It's just a superb company, top management, great balance sheet. It's just under $54. It's not cheap. If gold drops or is weak for if gold is weak for a few weeks, you could easily see that at 51.50. I would be a buyer there. But certainly if I were looking for one gold stock to buy, because I don't own any, one gold stock to buy, or one stock for my mother, or one stock for my children or grandchildren, this would be it without a shadow of doubt. And a long-term hold. No debt, 1.3 billion in cash, good strong cash flow, diversity of assets, etc. Another one that I like a lot is also a royalty company, Royal Gold. Now again, it's just over $71 a share. You see gold sort of soft for a few weeks. That's going to drop, into the mid 66, 67. And I would be a buyer again at that point. And again, a really good company, probably has a little more leverage than Franco-Nevada, but it also doesn't have a strong balance sheet as Franco-Nevada. And that's a comparative comment. I mean, if I were to buy only two gold stocks, that would probably be my second. So it's not that I think they have a weak balance sheet. It's just if you're comparing the two, this one probably has more leverage but doesn't have such a strong balance sheet. So those are two that I think are just core holdings for people. In terms of ones that perhaps have a little more, upside, let me try to, near-term upside. I think Reservoir Minerals, which has a discovery and a joint venture with Freeport Copper in Serbia, a stunning discovery, and also has a lot of 100% ground of their own around discovery, but they're drilling themselves right now. Reservoir at RMC on Canada or RVRLF on OTC. Trading at around 567 Canadian. It's got about $40 million in cash. It's a very strong company, very good management. They've got a discovery, but they also have the potential of, some discoveries on their own ground. So I think that one, has a lot of upside in the near term. I should point out that our firm owns 5% of Reservoir. I should point that out, I guess, as a disclosure.
All right.
But you wouldn't expect me to recommend something if we didn't like it.
Yeah, that's definitely true. So, yeah. And one other thing is, you've mentioned two royalty companies. I was wondering, in this industry, it seems like capital is hard to get right now for miners. And just out of curiosity, why do you think there's so little royalty and streaming companies with a market where miners are starved for capital? This seems like it's perfect pickings for them.
Well, I would dispute your. I'm not sure that there are so few. I mean, Frank and Royal are the two big ones, but there's also some other royalty companies in gold and also in the resource sector. So a company like Virginia, for example, which is one of my favorite long-term holds, started life as an exploration company, but they made a discovery and kept a royalty on that discovery. So that royalty is now their biggest asset. And they are now acquiring with other deals that they're doing on their ground, they're always keeping a royalty. There are some wholly royalty companies like Callinan Royalty, which is base metals as well as some gold. Gold Royalties, which is a much smaller one, but is looking at small royalties. So there are a few of them. I mean, I think the truth is that any time a royalty is available, there is intense competition for it. So, one could argue whether that means there's a shortage of royalty companies, but there's always intense competition for it. I think the other thing to remember is if you said there's a lack of capital in the business, and you're absolutely right, but if I want to start my own royalty company right now, well, I've got to go out and raise some capital to do that. So it's difficult to start a new royalty company. But you hit on a really interesting thing right now when you talk about the lack of when you link the lack of capital to the royalty companies, because of course when you're an exploration company or even a mid-sized company and you want capital either to develop a mine or just because you're an exploration company, you don't have any revenue stream, you need capital to continue exploring. You can go out and get debt. That's very difficult for exploration companies. And even for developmental companies, it can be expensive, not so much in terms of the interest rate that you pay, but in terms of the conditions that are put on that debt. The second way you can do it, of course, is to raise equity. But in this kind of market, selling equity, even if you can do it, and you mentioned how difficult it is, but, even if you can do it, it tends to be highly, highly dilutive at these levels. And so, the third way and an attractive way, I think, for many people is to go to a royalty company, sell a royalty on either a developmental project or an exploration ground. And what tends to happen, the good royalty companies like Franco, they tend to be partners. Franco-Nevada gets a royalty on a developmental project. Obviously, they can get a better deal and pay less for it in today's market than, in 2011, obviously. But Franco has no interest in squeezing that company so badly, but they never get the mine built, obviously. So the royalty company tends to be a partner, and that's what I really like about it. They're not trying to, excuse my French, screw the company. They're trying to get a good deal for their shareholders, but one that also makes sense for the company selling a royalty.
Yeah, that's true. No one would partner with those royalties if they were screwing them.
Well, some people would because they'd have to. But you're right. Yeah. It would make them look twice. But it wouldn't be. My point is, it wouldn't do the royalty companies any favors. Because if a company is in such a position, I mean, I know Franco-Nevada has actually voluntarily reduced the royalty on some of the projects they have because, the royalty was hurting the mine's profitability. And they can only make money if it's a profitable mine so that the company wants to continue mining.
Yeah. Silver Wheaton did that with Alexico.
Exactly. Yeah, well,
So.
Silver Wheaton's another one. I'd call Silver Wheaton one of the top, good quality royalty companies, and they look at their companies as their companies as partners.
All right. Well, I have to say it's nice having you on again.
Well, thank you.
You're welcome. And if people want to find out more about you, I know you manage money, you have a newsletter, and you also have the Euro Pacific Gold Mutual Fund. How can they do so?
Yeah, well,